We are super excited to welcome in our good friend, Tom Wheelwright, on the show tonight. Now, this is something that we're doing right now for our private group, and we wanted to open it up more broadly a little bit later, but we're super excited to have the genius, the smartest tax accountant in probably in the world.
The Sultan of Tax.
The Sultan of Tax joining us on the show today. It's been something we've been wanting to do for a long time, being able to have Tom here in this group, be able to field questions from you directly, some of the things that are really troubling you. What would you say? Holding people back from things or questions that they just cannot get an answer to.
Right. Well, we're filming this during the time of COVID. We're sort of towards the end of what we think are lockdown periods, although
Right.
Who knows. And Tom's been doing an amazing job of keeping investors up on what these stimulus programs mean, what the tax rule changes mean. So if you're not following Tom and his show, you are misinformed. But we're going to ask him questions in person. So hopefully you're doing both. You're following him here and you're following his program. Tom, you are so busy. Thank you so much for taking the time.
Yeah, welcome, Tom.
Thanks so much for having me. It's always great to be with my friends Clayton and Natalie Morris. So.
Well,
and you have such a great group too.
Well, we have such a great group of people here. Many of them are already WealthAbility clients. So before we get started, we should mention on our website at Morris Invest, we have our lower taxes tab. We even built Tom into our website because that's how much we believe in what Tom teaches, his guidance, and his team at WealthAbility. So anyone who's interested in working with Tom and his great team, please come over to our website, book a call with his team, and they'll take great care of you. So Tom, before we get started, can you give our audience just a background of your history in understanding the tax code, your career, and where you are right now with WealthAbility?
Absolutely, thank you. So I grew up in Salt Lake City, Utah. So I was a good Mormon boy and spent 2 years learning how to take rejection in Paris, France. And then I did my undergraduate work in accounting from the University of Utah, went on to a master's of professional accounting and tax at the University of Texas, the premier tax school in the world. And then I went from there, started my career at Ernst & Whinney, which is now Ernst & Young, one of the largest CPA firms in the world. And after a couple of years in the Salt Lake City office, I transferred to their national tax office and learned from the best and brightest there, kind of postgraduate education. And I actually created and taught classes to the CPAs around the country, including classes on the new tax legislation, which was then the 1986 Act. So it's been a long career. In the meantime, I moved to Phoenix to run the real estate tax practice for Ernst & Young. And then I spent 4 years at a Fortune 1000 company as the in-house tax advisor, again, specializing in the real estate arm of that company. I spent a very short period after that with another big accounting firm. It wasn't a good fit values-wise, so we parted ways at their insistence. And I started my first CPA firm. And while I was starting the first CPA firm, I also happened to have an opportunity to begin as an instructor, a professor, an adjunct professor at Arizona State University in their Masters of Tax program, and was actually an adjunct professor for 14 years there. I created a class on multi-jurisdictional tax for their Masters of Tax students, and then bought, sold several CPA firms. The last 10, 12 years, as you know, Clayton and Natalie, I have spent a lot of my time on the road with a fellow by the name of Robert Kiyosaki and his adorable wife, Kim, talking to people around the world about taxes and how to permanently reduce your tax. A number of years ago, I wrote this book that you're all familiar with, I know, because Clayton and Natalie talk about this all the time, Tax-Free Wealth, which
We do.
was before we released it and continues to be the best-selling tax book on the market. And because of that, I end up with people asking me all the time, how do I do that here? Okay, so how do I do that where I am? So what we decided to do was sell our CPA firm and focused solely on finding CPAs who were entrepreneurs first, who could learn how to do what we teach. So we now have a network. It's only been a couple of years. We have a network of 40 CPA firms around the US. And we are teaching them our system for reducing taxes. And so they're students. They've become systems of our tax reduction system, which is a proprietary system that we use to reduce taxes by 10 to 40% within three to 5 months. So that's what we're doing now. We're very excited about that. I just finished with a 3-day class with our network members, teaching them basically how to work with clients. So I saw some of those questions come in, and how to work with your CPA is a legitimate question. And we've been teaching the CPAs the other side of that, because CPAs tend to be very good at numbers and not always good at communication. So that's what we focused on for the last 3 days. So it's absolutely always a privilege. I love taxes. I've been doing this for 40 years, as I mentioned, and this is my life. So I am totally a tax nerd. So I love it whenever we can talk tax.
Well, we've got the right guy on the show today. And so our Financial Freedom Academy members are super excited about this. We've been excited about it for a few weeks, for a few months, actually. And then, of course, we had this pandemic. We had to reschedule and everything. So it's been a lot of anticipation about it. So what we wanted to do is dive into a bunch of the questions tonight. And before we get there, before we get to any of those questions, is there anything we need to know right now that is on the tip of your tongue that you've been talking about on your podcast, that when you're looking at the PPP loans, when you're looking at the CARES Act, that you want to make our audience aware of before we get to some list of questions here?
Or even soothing words, if you want to tell us
Right.
It's not that bad.
Yeah, well, I will give you some soothing words. The soothing words would be, for those of you who have PPP loans, and you have that 8-week period, and you're going, how am I ever going to use that money in 8 weeks? And especially when I have to use 75% on payroll. The House has already passed a bill, and the Senate is expected to take it up in the next couple of days to make that period longer. The House made it 24 weeks. We'll see if the Senate says 24 or 16, but it will be longer. And to not require it all to be used for payroll, but reduce the amount so that, for example, a restaurant, somebody that's got a commercial sticks and mortar type of operation, they've got a lot of rent, but they're having a tough time hiring their employees back. So that they're going to give us a little more flexibility. That is on the horizon, and that I do expect any day now, and we'll let you know as soon as that comes through and what that means. We'll of course do when that comes through, I'll of course do my own webinar, and I'm sure we'll get in Natalie that information. The other good news is that there will also be another stimulus package. That is absolutely sure. We don't know what it will look like. We know the House has passed their version of it, which is very different than what we expect the final version to look like. There are a couple of things we do need to be aware of in that House version, one being that the net operating loss carryback that was opened up in the CARES Act they would decrease the benefit of that somewhat. So we do need to pay attention as that's coming, but that's also hopeful news. I do think there will be another round of stimulus checks. I don't think there will be another round of loans like the PPP loans. So for those of you who are entrepreneurs, there might be something in there about real estate. And I know that's your big focus here. And what we're hoping is that there might be some help in there for people who are, instead of the CARES Act, which was focused on employers and employees, there's maybe a little more focus on tenants and landlords.
Yeah, I hope so. I mean, in the HEROES Act, which is sitting on the desks of the Senate right now, after they took a 2-week vacation, and they're about to take another 2-week vacation, there's $100 billion allocated for rental assistance. In that HEROES Act, there's $75 billion for mortgage forgiveness for landlords. So it kind of hit on both pieces of this mess that we're dealing with right now. Whether or not the Senate approves those pieces, I don't know. But look, it is the beginning of June right now, and this is when rent is due, and we're about to see. I'm leery about this. Perhaps a flood of evictions. So maybe that will prompt the Senate into action on that piece.
Yeah, Tom's most recent podcast with Ken McElroy is about what happens if you can't collect rent on your tenants. So seek that out. Everyone on the WealthAbility podcast, some great nuggets there. But let's go ahead and turn to questions, because one of the beauties about the way Tom sees finances from various angles, like what happens if landlords can't pay, then mortgages don't get paid, then taxes don't get paid, and how does that play out for all of us? So I'm sure we're going to get a really good holistic look at that. So what do you want to?
Yeah, I'll kick it off with the first question. So the first question is from Drew. He's a longtime member of the Financial Freedom Academy here. So Drew asks this question. Let me just put this back up here. Oh, sorry, that's the wrong one. I had a link up here. Oh well, it's not there. Okay, so Drew asks this question. He says, I've now seen the good and the bad side of leverage. Do you have any tips or overall strategy on how to use leverage well without getting over leveraged? We buy cash flowing real estate with leverage, yet we've still found ourselves in a few tight spots even before COVID-19 hit. What would you say to Drew on that question?
So you're right, Drew. Leverage is a two-edged sword. That's a two-edged sword. And that's why a lot of people stay away from debt. That's why you hear certain podcasts that say never have real estate debt from people who have been burned by leverage. Leverage is something that you use very carefully. And so what I would do is when I buy real estate, I want to make sure it can withstand some vacancy. Okay, and some serious vacancy. So I know the best real estate professionals I know, their real estate can withstand up to 50% vacancy. So if you can only withstand, if you buy a rental property and you base it on 7% vacancy, which is, we know, 1 month, right? That's what we're saying. Well, 1 month vacant. I've been in real estate long enough to know that you're going to have properties that are vacant for way more than 1 month. So you need to be able to handle that. So it's a function of two things. One is capital. Okay, you want to make sure that you are sufficiently capitalized. So don't be thin. Don't be thin on your capital. And the other is, this is the word that Kiyosaki's always talking about. I know this is the word that Clayton and Natalie are always talking about, but cash flow. Make sure that this is going to cash flow even in a challenging situation. And then you're never going to have to worry about it, right? You can use the leverage, but you're not dependent on every single renter paying their rent.
The calculation we usually use is annual cash flow. And then you take 60% of that, and the 40% you set aside for vacancies, expenses, taxes, insurance, right? So how much vacancy, I guess, are we calculating if we're only putting away 40%? Should we put away more than, if we're calculating our cap rate, then perhaps 40% is not enough if we're really going to get conservative about leveraged buys?
Well, if you want to be really conservative, you'd probably be at 50%. But 40% is not a bad number. The challenge that a lot of people have is they get so excited about leverage and so excited about what Kiyosaki talks about in leverage. They get excited about the tax benefits of leverage. And so they kind of overextend themselves. So what I saw with my professional investor clients the last few years was, instead of, like, they might have been at 75% loan to value, they were pulling back to 70, 65, and even 60% loan to value. So that loan to value ratio, you just have to watch that as you anticipate what might happen in the market. That's why understanding the market, that's why what you guys do is so important, because understanding the market is where we know when do we reduce that leverage.
Right.
So maybe you can leverage on a sliding scale. like the first asset that you leverage, you can use these kind of baseline numbers, but as you leverage more and more things, you get more and more conservative with your calculation. Is that a good way to put it?
Well, part of it's because of this work right
Right.
here. Because capital, as when you have capital, you can leverage, okay? Because you have an offset for that. It's when you don't have capital and you're relying solely on cash flow, which is what happens as you deploy more and more of your funds, that you have to be a little more conservative.
Yeah.
Great. Okay, great answer to Drew's question there. Thank you, Tom, for that. Let's move on to Vance here has a question. Thoughts on borrowing, ultimately withdrawing the $100,000 from the retirement accounts under the new CARES Act passed at the end of March. Looking to borrow and pay taxes on it over the next 3 years and not have to worry about the 10% penalty. How does this vary between traditional and Roth accounts? Does the $100,000 apply as total against an IRA or a solo 401k? For a Roth, does this mean we can pull out not only contributions but the earnings as well and only pay taxes over 3 years on the earnings without penalty? So there was a bunch of questions there. Let me know if you need me to repeat any of those, but we want to tackle that first piece. Should you do it?
Let's break it down and let's kind of start big and then we'll get a little smaller. Before we ever get to why you would do this or anything else, we do have to understand the requirements for doing it. And they're actually more narrow. As I was looking at this question, I went back and refreshed my memory, and they're more narrow than you might think. You actually have to not just have a financial impact. Now, if you got COVID, you qualify. If your close relative got COVID, you qualify. Okay, so people who got COVID and couldn't work because of the virus, they absolutely get that benefit. People who were downsized.
Those antibody tests are so unreliable.
That's right. Oh, if only we had antibody tests to prove we had COVID. No, it's actually we have to have been laid off work or not been able to go to work or not be able to do our business because we had the virus. It's not enough to have had it. We actually have to have been financially impacted from having the virus, or your business that you're an employee of had to shut down, or the business you're owning had to shut down as a requirement. And so it's really, it's not just any financial impact. So let's say, for example, your sales decreased as a result of COVID. That is by itself is not enough. Okay. However, if your paycheck was decreased, if you couldn't go to work, it was decreased, or if you couldn't open your business, then you qualify. So not everybody qualifies for this. If you do qualify for it, let me tell you, you should absolutely do it. In my world, because I'm not a big fan of qualified plans in the first place. So once you qualify, let's talk about what it means to take out $100,000. First of all, it's $100,000 in total. All of the plans you have together, you can take out $100,000. So add them all up, and you can just take out $100,000. That's your maximum. So this is the max right here that you can take out. Then you have two choices. So your choices are, you can pay tax over 3 years. So you can pay tax, you can just take it, pay the tax over 3 years. Or and this is one I love.
This is a good one.
You can pay it back in 3 years and pay no tax at all. Okay, so you can treat it as a 3-year loan. Remember, we've always had this 60-day rollover. This is a 3-year rollover. That's how it's treated. 3-year rollover. That's where that's where the law is written. It's just extending the rollover time from 60 days to 3 years for money that you take out in 2020 for this reason. No penalty. If you don't pay it back, you have to pay tax over 3 years. If you do pay it back, then you don't have to pay tax at all, and there's no penalty at all. It applies. It doesn't matter if it's a Roth or a regular. There's just whatever tax or penalty there would be, you have no tax or penalty, but you still only have $100,000. So obviously, you're going to want to take it out of a taxable account before you would take it out of a Roth account, because the benefit is bigger, right? A lot of Roth distributions aren't taxable anyway. I mean, after 5 years, you can pull your principal out of a Roth with no penalty, nothing. Just pull it out. So think about Roth. Take the non-Roth first would be the idea, and then if you don't, if you decide, well, I'd like to take my Roth out, you can do that too.
Will the IRS be asking what we've spent that on, or will there be a burden of proof?
No, it doesn't. There's the only requirement is, are you eligible to get the 100,000? There's no requirement for what you spend it on. It's not like the PPP loan where you have to spend it on certain things. You can spend it on anything you want.
Okay. All right. So did we answer all parts of Vance's question here? I think we did.
Yes,
right?
and that was Drew's tag-on question: is does the IRS care how that money is spent?
Okay. Good.
Yeah.
All right. Here's another question from Harvey T. Do you want to take this one?
I can't see it.
Scroll down to Harvey T. Right there.
There we go. Okay. What's better for business? Online banking when just starting out, or local? Okay, I'm sorry. What's better for business banking when just started out? Online or local? What is working? Stationed overseas? How can we use our business to invest in oil or gas and silver? These are several different questions.
Those are several different questions.
Yeah, the first question is a good one. We get this a lot too, because small businesses don't want to pay fees, and the big banks have robust online services but high fees, and the local banks don't. So have you got that question before? What's your opinion on that?
So it's a really interesting one, and my answer is both.
Use both.
I would actually want both. I would use both, and here's why. We learned this the hard way with the PPP loan, right? The PPP program comes out, and the big banks say, we're not interested. If you're not one of our top customers, we're not interested. The small bank, my clients who had good relationships with the small bank, they got the PPP loan in the first week.
Wow.
My clients who didn't have a relationship with a small bank, like me, by the way, I didn't have a relationship with a small bank. We had to wait several weeks to get our PPP loan.
Yeah, we were being raked over the coals with like Wells Fargo. We know so many people that were waiting on Chase and other big banks. We heard from people that were like dealing with Wells Fargo and Chase and other big banks. But then people went with some of these fintech companies like PayPal. They were able to get it almost immediately.
Yes. Yeah. So I actually since then have started developing a relationship with a small local bank for that actually exact reason. And plus it's easier to borrow, you've got more flexibility in credit cards. So I like having that relationship with a small bank. On the other hand, especially when you're overseas, having the big bank for your operating accounts, to me, makes a lot of sense. Some banks, they're different on how good they are in online banking. My experience is Bank of America, frankly, is the best online banking. They're the easiest to deal with. They're the best from an accounting standpoint. So I use them for that purpose. But again, they're they're impersonal, and it's, they basically told me when I called them, well, you're going to have to wait in line until our best customers come in.
Oh my
Right.
gosh.
Wow. Well, let's
Yeah.
answer some of the other.
One other point I wanted to make about that, though, is that now we see those banks with smaller online services have really beefed them up because of COVID, because they're trying so hard to keep you out of their branches that they, for instance, when you couldn't make more than a $5,000 mobile deposit, and now they're like, do all you want, bring it on in, so maybe some of that will stick. What do you think?
I would expect so. I certainly think the way we do business will change forever here because people are getting comfortable with it. I mean,
Right.
let's face it, ordering groceries online is a pretty easy thing to do. So once you get used to it, why not do it? And I think so. I think that that's going to stick. It's just you do have to consider what services do you need, what services do you want, and what's more important to you. That's the choice you're making.
Yeah. We should mention, and Kelly can drop this into the chat for the rest of the members of the Academy right now. We've teamed up with Novo Bank, which has been great. They're all online. They're able to save brick and mortar, and they sent out emails. They're like, hey, if you're having trouble getting your PPP loans, we're able to get them approved very quickly because they don't have to deal with all of the legacy brick and mortar. I have a Novo Bank account, and they've been great. And they work with TransferWise. It's all digital. So Kelly, maybe you could drop that in the chat here for other folks if they're interested. I wanted to kind of go back to something Harvey was asking because it seems like he's struggling with growth and he's overseas and he wants to maximize his growth. If we are younger like myself at 30 years old, he says, how can we maximize growth? I own 2 rentals. I live in Italy via the military, plan on contracting afterwards. I haven't set up enough time in the working world yet, but I have taken advantage of some of my TSP for a closing on my second rental. What else can I do? Is there anything from a tax perspective in your wheelhouse expertise that you could point Harvey in the right direction?
Well, I would point 2 things. First of all, from a tax perspective, remember taxes are your biggest single expense. So it's actually the easiest way to free up cash is from the government. And all we have to do is do what the government wants us to do. And one of those, for example, is a cost segregation. So I know you're familiar with cost segregations because I've talked about it on with Clayton and Natalie. But a cost segregation is a way to get cash. That's really what it is. It's like net operating loss carryback. It's a way to get cash. So as far as more capital, I think the 2 best people to get capital from are your customers and the government. Okay, those are the 2 easiest ways to raise capital. And that's why, for example, seller financing is so good because you're really getting capital from your customer. In this case, the seller. So anytime you can get cash from one of those 2 places. But let me give you a third option. There's I know that Clayton's very familiar with this because he had all the Rich Dad advisors on Fox and Friends back in the day to promote this specific book. And this is a book about how to build a team. And if you really want to leverage a team, if I can, Clayton, let me just remind everybody.
Please do. And it was a great interview. We had you, Robert, Ken. We had an amazing team. Garrett Sutton was on the show that day talking about the team and how important it is to have this team in place.
So remember, if you're over here and what you're trying to do is you're trying to go here, right? Or you're here and you're trying to go here, right? There are certain things that are different on this side of the cash flow quadrant, Robert Kiyosaki's cash flow quadrant, than on this side of the cash flow quadrant. And one of the big ones is over here, the words are always do it yourself. And boy, talk about learning, going backwards with COVID-19. We're all learning how to do it yourself. My son-in-law is cutting his own hair. I mean, talk about do it yourself.
Right.
So
I did that for all 4 of my family
you know,
members.
I know more men who actually started shaving their head under COVID-19 because the only way you can figure out how to cut your hair. So unfortunately, but this is do it yourself. What over here, it's always a team. So you want to talk about leverage. Leveraging a team is so much more important than leveraging money. Leveraging money is great, but if you want real leverage, you're going to leverage a team, who they know, what they know, what they can find. You want growth, you want better investments. Don't be doing it all yourself. Go find somebody else. Andy Tanner, who's the Rich Dad Advisor on cash flow from stocks, he was speaking at our conference last week, and he also said something very, very interesting. He said, over here, there's fear. And in the E quadrant, it tends to be fear of control. So they're afraid of taking control. In the S quadrant, it's a fear of losing control.
And for those people who aren't even familiar with this, and I know everyone in our academy is familiar with these quadrants, but that's employee, E, up in the upper left. That's self-employed right there. So when you're an employee or self-employed, fear of control. Wow.
And if in your small business, the reason you're not growing is because you're fear of giving up control. You're fear of losing control. Okay.
Right.
So fear drives this side of the cash flow quadrant. Over here, we have a big business. And in the PPP loans, that was emphasized again, big business is 500 employees or more. And we have professional investors. Over here, this group is all about faith. And I'm not talking about religious faith. This is in B quadrant, it's faith in people. And on the I quadrant, not only is it faith in people, it's faith in markets. If you listen to some of the great investors, okay, Warren Buffett, he gave his presentation at his annual meeting the other not too long ago. He says, "Look, we're not going to be afraid of this. We have faith that it's going to come back. We know it will. It always has." So it's like, okay, the sun went down. Oh no, what if it doesn't come up? And yes, it may not come up for 2 years. Eventually, though, it's going to come up. So we see this over and over again, and I think this is a big difference. And this faith in the team is a huge difference between, from the fear of losing control. And if you can't grow, fundamentally, that's what's going on. It's all in your head, right? It's like Blair Singer talks about your little voice. That's what's going on from a growth standpoint. It is not a lack of money. It is not a lack of time, and it's not a lack of knowledge. It's fundamentally fear and our little voice saying, you have to do it this way. You have to do that. What if I run out of bank loans? Well, why are you relying on bank loans?
Right.
Okay. What if I can't? What if my renters don't pay my bills? Why are you hoping, afraid that they're not going to pay their rent? Why don't you go to them ahead of time and say, wait a minute, okay, we know you're struggling. Let's work. If you need to work something out, let's work something out. And that's what we did with our clients. And our clients are serious. They're serious business owners, and we said, look, we're going to help you any way we can through this crisis. But even if you need to make payments, let us know. We will work with you to make payments instead of having to, pay your bill all at once. So it's really a matter of, and I'll tell you one more thing if I can, Clayton, Natalie.
Of course.
I find these people are frequently on their heels. They're reacting. Okay, they're backwards. They're always leaning backwards, whereas these people are always on their toes, leaning forwards. And that this is something that I'm teaching our network members: is stop leaning back, start leaning forward. Get off your heels, get on your toes, because that's where the growth is. That's where the fun is too.
Oh, that's
So
it. And
would
it's
you
perfect too during this pandemic. So many people have been sitting at home, just like, all right, they're just going to watch Netflix every day.
Right. So would you say that now is a good time to sort of double down on your study and on your plan? Because one of the things you said in a recent podcast was, it was like, don't grab a broken glass or don't grab at a falling knife. What was the expression?
She's
Don't,
terrible
Don't
with
grab a
idioms.
Don't grab a falling
Don't-
knife.
Don't put the cart in the horse.
Right.
Don't put
That
the.
was Ken said. Don't grab you don't want to grab a falling knife, and that's his concern about the investing in the market right now.
Right.
That's what he was talking about. It's a falling knife. You're grabbing a falling knife, whereas you're much better off. If now I remember very well what Ken was doing in 2008, because I was a Rich Dad Advisor, and I was watching. And Ken didn't start buying in 2008. It was a falling knife.
Yeah.
I watched, and he did his buying in 2010, 11, 12, 13, 14. So, patience over here, patience isn't just a virtue, it's a requirement.
Right.
Yeah.
Right.
How will we know when the knife is hit the ground?
Oh, well, you'll know because prices will start coming back up.
Okay.
So, yeah, so if you look at, let's look at a market, right? Okay, so here's a market, and it goes, it goes up, it comes down, it goes up, comes down. This is what's happened, right? Then it comes down. We're like here, it's been coming down, and we kind of got a little bump back up, right? And then let's see it come down again. Well, what Ken's saying is, don't buy here. If what you're going to want to do is, as this starts going back up, you buy here. You're buying at the same price, right? You're just buying a little later because you're waiting to see, is it going back up or is it still coming down? See, are we still doing this little thing, right? Or have we gotten past this little blip and we're coming down again? And then you kind of watch that. And that's why I always recommend people get some education on stock trading. Because this is a stock. This could be a stock chart, it could be a real estate chart, it could be a stock chart. And what stock trading does for you, this is why I love having Andy speak at my events, is what understanding stock trading does is teaches you how to follow a market. And that's what we're talking about. How do you follow the market?
Yeah.
Right. And when you look at, we just had Ken on our show, and he's been sitting on his hands right now in the multifamily space because he does the large multifamily stuff, and he's worried about the commercial paper market and all of those things, and overbuilding warehouses and overbuilding hotels. And then we're seeing that's the market right now. And then you're seeing the residential side. We're seeing mortgage prices at their lowest level in history. And we're seeing housing prices mostly staying, single family homes and that area in the residential space still kind of staying fairly stagnant. And even in some areas going up. There was an 18% surge in mortgage applications this week. So I guess you got to pay attention to these. You really got to watch this stuff week to week right now during these major events, right?
Yeah, for sure.
Yeah.
So we got some more questions here. Natalie, fire them away. We're going to do a little rapid fire here.
Okay. Daniel says, my wife and I use TurboTax and it's worked well so far. My question is there anything in TurboTax we should be on guard with or any hidden secrets?
Refer to chart A. This is TurboTax. Okay. This is how to be a team member to do that. I do not understand why you would do that yourself or you would do your own bookkeeping. It's not that expensive, because what you're doing is you're leveraging not just, it's not about a program, okay? The approach, if you're using TurboTax or you're doing your own bookkeeping, you're going, wait a minute, I've got some time, I can do this myself. What you're not leveraging is everything else. So, for example, what the small bank that I am, exploring, I really like them. The small local bank, they came from one of my members. So I'm actually doing a coaching call with her, and I'm going, here's what here's the issue. And she go, oh, well, because she's here in Phoenix with me, and she said, oh, by the way, let me give you a contact here. These guys were great for my clients, and they'll take you they'll do your PPP loan even if you're not a client yet. And I'm going, okay, team. But see, I got that. Who did I get it from? I got it from, one of our members. So what I did a podcast several months ago about, and this guy said that he wanted to die before his banker died. Why? And he goes, because my banker knows everybody. And so I don't want my banker to die. He's always giving me referrals. He's always telling me, do this, do this. So your CPA is the most experienced business person probably in your life, is your CPA. You've seen so many different businesses, so many different situations. They can read financials. They can analyze the law. You're relying on your own knowledge when you could be buying knowledge. I can't comprehend that.
Well, and the amount of money that you'll save from working with a great team like you, the team at WealthAbility, and be able to work with experienced a tax team that's doing tax planning throughout the year. So it's not just about the software program and filing the taxes. It's all of the work that you guys do. And not just your company, but we hope other CPAs would be doing what you guys do, which is the tax planning.
For sure.
Yeah. And there's certain ways, for instance, that Tom has coached. We are within the WealthAbility network, and we've come up against something that's kind of complicated, like, can we take this deduction? And they say, well, Tom has taught us this special thing. We're going to refer to Tom. TurboTax will not let you be creative in that way. There'll be certain things where we'll put in, like, we are taking this deduction. TurboTax would just give you an arrow.
Spit out an arrow.
No, you can't do that. And so your experienced accounting team is going to say, we're going to do it this way, and we can defend it if we have to.
Yeah. So Daniel, hopefully that answers the question. Go ahead, Tom.
Well, one of the reasons we set up this network is because I found that if all we did was own a CPA firm, and of course we're working with people like Robert and Kim Kiyosaki, right? I mean, everybody knows they're a client of ours. Well, how do you hire people to work with that level of people and still work with people who are just starting out? You can't afford to charge less to the people who are just starting out. With a network, we have a huge range of pricing when it comes to both the initial strategy, as well as the long-term consulting and accounting and all that kind of stuff. So you don't have to spend a lot of money. You don't have to be with our top tier firm, right?
Right.
You can be with another firm that loves your market and that you're the ideal client for them.
Yeah, perfect examples like our family members. There's members of our family that work with your team. They don't do what we do, which is all of the properties that we have and our business structure and everything else that we've got going on. We're in different buckets,
We're both with different firms.
Right, exactly.
Different WealthAbility firms.
Within the WealthAbility network, which is amazing. All right, I want to get back to some questions here, rapid fire. Let me see here. Where did I have? Oh, I wanted to get to Chris A. Chris A, who's watching live right now, Chris Allen. He's asking the question, regarding cost segregation, is there a value of a property where it makes more sense not to cost segregate? I may have missed it, but I'm just wondering what passive investors can still benefit from when they have rentals owned.
Those are two different questions.
Okay, so that's Myra. Sorry, those were lumped together. So the cost segregation question.
Yeah, I'm sure there is. Right? I mean, that's a matter of pricing it out. Remember, you do have a couple of options now, because you can have somebody do all of the work for you, or there are some online programs where you can do some of the legwork if you want to do a little bit of the do-it-yourself, because you're not, let's say you want to employ your children as an example from there's tax benefit there. And so you employ your children, they do it. So you're not really doing it yourself, you're using your children in your team and you're paying them to do it. And then what you have to do is you have to have your accounting firm sign off on that. So they have to be comfortable that you know what you're doing because the accounting firm is signing off on it. But there are tools online that go to your accounting firm and ask them, will you work with us on this?
Okay,
great. So we have a few more. I want to get another one that Chris A. was asking here. Natalie, do you have that one?
He says, after setting up your asset protection LLC, and then one LLC is the holding company and the other owns the properties, what's the best way to set up banking and distributions? So LLC 1 owns the property, but it's owned by LLC 2. How does that money flow, and then how is it taxed?
So I'll just draw this real quick. We'll be fast.
No problem.
It's like Pictionary.
Right.
Remember that show from was it the 90s
Win,
or the
lose,
80s?
or draw.
Oh, Win, Lose, or Draw. Yeah.
So we always draw pictures because that's the best way to communicate with lawyers because they don't really understand things and you should draw pictures.
It's true.
This is your holding company, okay? And this will be P1, P2, P3, right? Okay, so all the money needs to come in and out of here as far as the operations of the rental property, right? But your capital, so you're gonna have, so capital is gonna go from here to here, and then from here to here, right? And then distributions are gonna go from here to here, and then from here to here. So,
Okay.
there you go.
And so they each need their own bank account.
Yes.
And because I've tried before to not have, Joy is our bookkeeper. We've talked about her before. You introduced us to her.
Mm-hmm.
And I've done this before where I try to not have a bank account for the holding companies and just sort of, well, it's there, but I can take a distribution. She was like, nope, they all need a bank account. Every LLC does.
Yes, if this doesn't have a bank account, here's what you've just done.
Oh.
Yeah.
It's not.
Yeah.
The courts will say, well, you didn't treat it like a real company, so why should we treat it like a real company?
Right. Yeah.
Good
Okay.
point.
I got my hands
From a
slapped for that
tax
before.
standpoint-
So then how are they taxed? Then that money.
So from a tax standpoint, these three companies, actually in this structure, all of these companies are invisible from a tax standpoint.
Oh.
Not one of them has a tax return. There might be some state tax returns, especially if you're in the People's Republic of California. But the way I always set it up is I always have two members here, okay? And typically this is spouse, but it doesn't have to be. It could actually be a corporation you want. But we do two members. This is now a partnership, and the tax return is here. I don't like putting properties on a personal tax return if I can avoid it.
Yeah.
You show your tax return to a lot of people, the bank. A lot of people are asking for it. I don't want them seeing my properties. I don't want them seeing the addresses. So I'd rather have it down here, kind of self-contained. And then this files a tax return. It also is a lower audit risk if it's done down here. So and the asset protection is better if it's done down here. So if you have two members. So there's a lot of benefits to that. So I don't, I was talking to an asset protection attorney just this morning. He said he never sets up he would never do this without having a second member.
Okay. We've got another question from Drew I want to get to here. Drew says, how do we balance investing in different assets? And this might not necessarily be a question for you, but I'd love to hear your thoughts. He says, for instance, because of Clayton and Natalie's education via YouTube and podcast, we are investing in rental real estate, and we want to continue to do so for the cash flow. However, I've also been reading and rereading Mike Maloney's book, Guide to Investing in Gold and Silver. It seems that's a good way to go as well. But if we only have so much currency per month that we can put towards investments, what's the best way to allocate our resources towards the various investments?
Okay, now I'm going to share my personal philosophy. That's what it is. It's my philosophy. It's when I look at wealthy people, I've been studying wealthy people for years and years and years and years. And when I study wealthy people, what I find is they all have one thing in common. They all focus. They don't do multiple assets. Now, if you're talking about gold, if you're talking about precious metals, not from an investment standpoint, but from a wealth preservation standpoint, that's different. That's not an investment. That's wealth preservation. Okay? And I'm all for wealth preservation. That's the same reason for insurance, right? Wealth preservation. If you're talking about you're going to become really good at investing, you're going to do it one thing. You're going to do one thing really, really well, and you're going to do it over and over and over again. Follow one course until successful, and then do it again.
Right.
That's how that works.
It's so easy to be, you get a little bit of success in one area, you have some setbacks a little bit, and you start to question things, you get shiny object syndrome, and then you don't ever do anything fully, you do things half-assed, right, as my dad used to say.
Frankly, I learned that hard lesson in real estate. I lost a bunch of money in real estate thinking, oh, this is easy, right? And I was one of those who lost a bunch of money in 2007, 8, 9. Okay, why? Because I hadn't done this, right? I hadn't really focused. And so now I know where my wealth is coming from. So for me, it's business. Yes, I have some real estate because that's wealth preservation for me, but it's not growth. Wealth growth for me is the business asset class. And for other clients, it might be stocks. For others, it might be oil and gas or energy. And others, it might be real estate. So I would strongly recommend focus, focus, focus.
Great answer. Great answer. Let's do a quick one here from Vance. Does wholesaling count as being a real estate professional? First of all, can you define real estate professional? And I'm sure you're familiar with wholesaling real estate, which is really you're just the middleman in a deal. You're getting a property under contract. You're selling the contract, the paper, to a flipper who wants to spend 9 months remodeling the property. So you're not actually taking ownership of the property necessarily.
Right, you're finding and selling the property though. So I mean, you're brokering. Here's what I would do. So real estate professional, which is kind of a magic term in real estate tax law, because what it means is that this is basically your get out of jail free card, and you can use losses from depreciation against any type of income. So that's why you want to be a real estate professional. The rule is more than 750 hours doing real estate and more than all other business activities, including your job. Okay, so you have to meet both. You have to meet both, and then there's some technical requirements you have to meet. So don't do this on your own. Make sure if you want to be a real estate professional, you must have a professional accountant doing your tax return. If you do it on your own, you're just asking for trouble. So would wholesaling qualify? Well, here's what I would do. If I were wholesaling, and for a couple of reasons, I would get my real estate license. One, to protect me, because chances are, if you're wholesaling, the state real estate licensing board may not be happy with you unless you're licensed.
Right.
Okay, so because you're doing transactions, you ought to be licensed. So I do it for that reason. But the other is that once you're licensed, you're saying, look, I'm doing this as a licensed real estate agent. And as long as you own your own real estate agency, in other words, you're an independent contractor, then the IRS has said, actually the courts have said, is that if you're a real estate agent, your function as a real estate agent, as long as you own the business, qualifies. So I would not want to rely on wholesaling because there is a question there. I think it's a really good question. But if I'm a real estate agent and I'm doing it under my real estate agent license, I don't have any issue.
Right. And it's a great point because there are states like Ohio and others they'll crack down on you if you do not have a real estate license and you're doing wholesaling. You're basically brokering a transaction, so you better be careful of that. One final follow-up question here on this real estate professional point. We work with a lot of clients at Morris Invest that might be like a doctor or a lawyer, and their spouse is just, is a stay-at-home spouse. And once we explain to them the power of being a real estate professional, or even just on our podcast, it doesn't have to be a client, and they understand the power of being a real estate professional for their spouse. If their spouse got their real estate license and put in 750 hours, it doesn't have to be both spouses, right? It'd just be one partner. Could you explain that part of it and why that's so powerful?
Yeah, because you file a joint return, right? So from a taxpayer standpoint, you're one taxpayer. And I was talking to a client this morning, and he and his wife have been clients for several years. And when I was first explaining this concept, that look, if your spouse is, if in this case he was the business owner and his spouse was stay at home, and I said, if your spouse became a real estate professional under these qualifications, guess what? You'd get all those losses to be able to offset your business income. And she goes, yeah, I'm not interested. And then I ran the numbers for them. And all of a sudden she goes, I like real estate.
I love it. Yeah.
I can do that.
Right. I mean, if you're a doctor and you now know that you can offset your salary at the hospital because your spouse becomes a real estate professional, it's jaw dropping once you start running those numbers, right? Yeah.
Yeah. You want to talk about tax-free wealth? That is the easiest way to get to tax-free wealth.
Yeah. All right. We have two more questions and we'll get you out of here. No one gets hurt.
Okay. Vance wants a recommendation for a source for 1031 exchanges, like a book or a course or something.
There are a couple of books out there. One of a good friend of mine, Gary Gorman, and I don't know if the book's still in print, frankly, wrote a book about 1031 exchanges. Gary, unfortunately, is retired. His company still does it, and they're good. Okay, I still use them. The 1031 Exchange Experts is their name, and that's actually a pretty good book on it. 1031 exchanges, you don't have to know a lot. You really don't. This is where you talk to your accountant, because it's a complex transaction, and you don't want to do it by yourself. You must have a team. So you by definition, you have to have a team. You have to have a qualified intermediary who does the transaction. You have to have an accountant look at this. You have to have a lawyer look at this. So I wouldn't worry. 1031 exchange, all you need to know is I have to identify the property within 45 days of selling the old property. I have to close on the new property within 180 days of selling the old property. And it has to be equal to or greater. The price has to be, it's got to be equal or up. But here's something to think about. Because of bonus depreciation and cost segregations, you may be better off not doing a 1031 exchange.
Right.
Yeah.
Because of bonus depreciation and cost segregation, you actually may be better off tax-wise to not do a 1031 exchange. So again, sit with your accountant and run the numbers.
Right. And make sure you have that team in place that can look at those things. It's so important. I want to finally ask this last question here. You work when the WealthAbility team starts to look at a client. You and I have talked offline. What is the ideal client, right? For Morris Invest, we know what that ideal client looks like, right? It's someone who wants to work together as a team and wants to build wealth over the long haul. For WealthAbility, if anyone's watching right now who's on our live stream and here in the group, who's thinking about working with your team, what's your ideal client? And who's your say, no, we should not be working with you?
Okay, I'll tell you, rule number one, is you must participate. Okay, so we had somebody come to us a couple of months ago, and he makes $14 million a year in his job, $14 million a year in his job. And he said, I just want you to handle it. And we said, can't help you. And he was livid. He was just furious. He said, no. I read Tom's book. I know you can do this. I just want you to help me. We said, no, you're not willing to participate. He's not going to do investing. He's not willing to participate in the process. So I don't care if you make $0 a year or $100 million a year. You must participate in the process, because I can only tell you what facts to change. You have to change the facts to lower your tax. So that's rule number one. Okay, so we won't even take you on if you're not willing to participate. Because it's a team, right? And you're the leader of the team. I'm not the leader of the team. You are. Okay. So rule number two. You have to be willing to take advice. Now, Clayton and Natalie, you know my wife, Luann. And what you may not know is that Luann won't take a doctor, particularly a surgeon, as a client. Period. It's a hard fast rule. And the reason is because I asked her why. She goes, well, they already know everything. They don't need me. So I happen to have a couple of doctors that take my advice. Okay, so I'll take a doctor, but it's a limited circumstance. This is my requirement. You must be willing to take my advice. I will tell you, the ideal client. I'll tell you right now, the ideal client, Robert and Kim Kiyosaki, ideal clients. They're literally, ideal clients. They fully participate. They take advice. And this is, by the way, it's not just me. They do this with all their team members. And number three, you pay my fees and you don't ask questions about it. I'm dead serious. I've got clients that I've had clients that they were willing to participate. They're willing to take my advice, but they're going, yeah, but I think your fees are too high. I'm going, great. You don't have to be here. Okay. Right. So Robert taught me this. His very first accountant, and I can't, Bernie or something. Anyway, he said he questioned his fees once, and he said, well, look, you can pay me $3,000 or you could have paid the IRS $30,000. Okay. You chose to pay me $3,000. You ever question my advice again, you will not be my client. And that is actually the choice I give people. If you want to question my fees, I don't mind having a discussion about what work we're going to do and how much it's going to cost before we do the work. That's totally fair. But once we agree that here's what the fees are going to be, and this is when the fees are due, there's no question anymore. You just pay the fee. That's what it is. You pay for it. Helps. Your choice is what you've decided is you don't want to be my client. And so those are the top three.
Those are great.
Seems reasonable.
Those are more than reasonable. That's spot on. Perfect stuff, Tom. Any final thoughts here? We want to get you out of here and be respectful of your time. And thanks to everyone who's been watching the stream today. I know, and we will be able to play this replay in case anyone missed it, so they get to watch the full replay. Any final thoughts right now during this pandemic? Anything from a tax perspective or just a general business advice and wisdom that you want to impart to our group?
Just a couple of things. I want to thank, was it Vance who asked this question?
Yeah.
I want to thank Vance for this, because what I'm hearing is I want to be a good client.
Right.
Okay. I want to be a good team member. I want to be a good spouse. I want to be a good parent. It's who do you want to be? Because that's going to determine what you get in life, right? What you have is going to be dependent on who you are. Let's behave, right? Behave as, who you are is what you have. So to consider that, look, I want to be I made a decision years ago. I had a partner that was a terrible customer. In fact, we were doing a deal. We were actually buying a boat together together, and the boat the boat owner came to me and said, I can't talk to your partner anymore. He was so rude. He was nasty. He criticized all this kind of stuff. And I go, just talk to me from now on. Okay. My goal in life is to be the best customer in the world. Okay. That's one of my goals. So I want to be the best advisor, but I also want to be the best customer. So I very much appreciate that, because it really is, how are we going to treat people? And who are we? Can we just be a good person?
Right.
I know, Clay and Natalie, you read a lot of Stoicism and Ryan Holiday, and I read a book every day called The Daily Stoic. And today's was just, sometimes just be a good person. And I think that's a lesson that unfortunately a lot of people aren't following right now. And it'd be great if even our leaders would follow that. Just be a good person.
I would love that. I would love that. There was one question I just saw, and I didn't get Eduardo's question in here. You kind of answered part of it, but I want to help him out as maybe our final question. He asked, we were talking about the real estate professional angle, and Eduardo B asked, this would also help us with tax benefits of leveraging the cost segregation depreciation. The question is this: if we filed jointly for 2020 and she is classified as a real estate investor, can we leverage the depreciations and affect our final tax bracket? Currently, I'm in the 35% tax bracket upon marriage. Should she drop us down to the 24% bracket, but does it help us further reduce our tax liability? And that'll be our final question.
Yeah, the great news is you only have to get married by the end of December, right?
Wow.
As long as you're married December 31st, you don't have to be married the whole year. You just have to be married on December 31st. And your spouse, if she's not a real estate investor, but a real estate professional, so she has to meet the tests. If she's a real estate professional, then all those losses from all your cost segregations during the year, they're going to offset any kind of income that you may have, from business income to wage income to interest income, dividends, capital gains, doesn't matter. Your losses will offset any type of other income if she's a real estate professional.
Wonderful. Wonderful. Well, Tom, the great Tom Wheelwright, we want to make sure that people connect with you and your network. If you're interested in working with the team at WealthAbility and seeing if it's a fit, and being that ideal client, you can come to our website. We have a whole page devoted to Tom and his team. Just go to the lower taxes tab. It's right at morrisinvest.com/lower taxes. It's right at the top of our page. Connect there, book a call with Tom's team. And Tom, it's just been a thrill. It's always a thrill to get to talk to you. And it's just, I want to thank you personally for being such a great part of our team and always being so kind with your time.
And if you're not subscribed to Tom's WealthAbility newsletter, do that. They're holding amazing webinars. They're doing special YouTube lives just in this time of the pandemic to help everybody keep up on what they need to know. It's been extremely beneficial, especially to me, because I can't make sense of anything from the mainstream news. I need you. So at the very least, very minimum, cost you nothing, get on Tom's newsletter and follow his shows.
Yeah.
I appreciate that. What I appreciate about you guys is, of course, financial education is so important, and you understand the value of the team and the value of understanding what to do. One of the reasons we do all these podcasts and everything is because there are a lot of people out there right now giving you a summary of legislation, of rules, all this kind of stuff. What your accountant should be giving you, and what I hope to deliver always, is actually analyzing it and giving you an analysis. So make sure you find people who can analyze and help you with your analysis. And when you do, as we always say at WealthAbility, you always make way more money and pay way less tax. So thanks, guys, for having me. It's been absolutely terrific and phenomenal questions.
Thank you so much, Tom. Thanks to all of you for watching today. And thank you so much for subscribing, being a member here in the Financial Freedom Academy, being a part of this amazing group. We hope to be able to bring more of these to you on a regular basis. And our big thanks to Tom. Thank you so much.
Indeed. Thanks for joining us, everybody. Have a wonderful day, and we'll connect with you again soon. And thanks for your earnest questions and bringing knowledge that you had to share with the group as well.
Yeah, thank you so much, everyone.